Hello, everybody. My name is Grant Koppel. I'm an external wholesaler here at Innovator ETFs. And joining me today is Tim Urbanowitz, who heads up research and investment strategy here at the firm. Today, we're going to discuss our 2023 investment outlook, with today's topic specifically being an earnings recession and range-bound valuations. Tim, can you unpack that?
Sure. So really, when we think about equity market returns, we really think about it in three different buckets. What's coming from dividends, what's coming from earnings growth, and what's coming from multiple expansion or contraction. And this theme that we focus on in the outlook is really meant to focus on those last two points. And when we look at earnings, really what we expect is that the 5% earnings growth estimates that we see, that's consensus out there in the market, that's still very aggressive given the growth outlook. And when we look at valuations, we would expect valuations to be somewhat range bound, just given where interest rates are right now, but do see meaningful downside in the event that a recession plays out later in the year.
Sure. So you've said earnings estimates have been aggressive for a while now. They have come back. They've come down for the second part of this year. What makes you think there's still some room for them to go down?
Well, if you look at really what we're seeing is it's a disconnect between the growth picture and what the expectation is for earnings, and we think those two need to come together a little bit. You had the Fed that raised interest rates very aggressively. That's increased borrowing costs. They've put pressure on consumers, which translates into demand, which translates into earnings. So we really think there needs to be some reconciliation between what's happening in the economy and what's happening with earnings, and we think that will play out in 2023.
So what makes you think valuations will stay relatively flat?
Well, if you look at valuations, valuations are very heavily dependent upon interest rates. And you look at current interest rates right now, they imply a PE on the S&P 500 about 19 times earnings. Again, in the event of a recession, we would anticipate a meaningful downside to that. The other thing I think is really interesting here, if you look at the back half of Fed tightening cycles, in 11 of the last 13 Fed tightening cycles, what we have seen is that valuations have contracted in 11 of those 13 tightening cycles, with an average contraction of about 14%. So again, that would be fairly consistent with what we've seen historically.
So Tim, what would change that target?
I think either a bull case or a bear case scenario. In a bull case scenario, let's say you had the Fed that tightened just enough this year to slow growth but not kill it. They pull off that soft landing. We see interest rates coming down and valuations start to reverse some of the pullback that we've seen this year. And then in the bear case, which would probably have a higher probability attached to it, we have a recession that plays out. If you look at where the equity market is traded at recession onset, where it troughs, we typically have seen the S&P 500 starting a recession at about 15 times earnings, bottoming out about 13 times earnings. So we could see a downside somewhere in that range.
Okay, so with no boost in earnings, no boost in valuations, how should investors position themselves next year?
Honestly, we think investors need to be creative and think outside of the playbook that worked over the last 14 years of quantitative easing. They really need to think about, if we do have an environment where growth does slow, how do you generate an acceptable level of return? So we find it prudent to seek strategies that can help accelerate on the upside, but then also offer some type of buffer on the downside.
Sure. Yeah, so one ticker I would highlight is XBJA. It's really the only innovator ETF that offers both accelerated upside performance as well as a buffer of 9% over a 12-month period. It's tied to SPY. It gives you 2x the performance to a stated cap, but buffers you for the first 9% of losses. Well, thanks everyone for joining us today. I hope all of you have a very Merry Christmas, and we're looking forward to working with you in the new year.
Before investing, carefully consider a fund's investment objectives, risks, charges, and expenses contained in the prospectus, available at innovatoretfs.com. Read carefully.